if I have to summarize why my view has become more bullish as opposed to having been bearish for, most of the last couple of years, I think it's because the economy actually had been slowing and decelerating for the past 2 years. And finally, we are at a point where most of these policy headwinds are over. Policy uncertainty has diminished. The Fed is ready to cut. Fiscal is also turning positive next year in terms of the impulse. So all three major economic force that's shaping the economy is turning in a positive direction. So I think that that is one reason why I think the direction is an acceleration in economic growth from here on.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Much concern has been raised of late about how the economy is slowing and recession risk is rising. But is that really true? Or could we already be through the worst of things with the economy strengthening from here? To find out, we've got the good fortune to talk today with Dr. Anna Wong, Chief U.S. Economist for Bloomberg Economics. Prior to her current role, Anna also worked at the Federal Reserve Board, the White House Council of Economics Advisors, and the U.S. Treasury. Anna, thanks so much for joining us today.
Always happy to be here, Adam.
Thanks, Anna. I know it's been a busy week for you, so thank you for making time for this. Why don't we get to the heart of the question I just mentioned there in the intro there? There's been a lot of concern about the economy slowing down, whether recession risk was rising back up. We obviously had a lot of fears throughout the year that inflation was going to pick back up with tariffs and other things. We have been seeing the job market weaken to the point where the Fed has basically cited it as its reason for blinking and starting to cut rates again. It does not look like we're going to get the latest BLS jobs data this week because of the government shutdown, but we did just get, I think, the ADP report, which came in at negative job growth. So, there's an understandable, scope of people out there that are worried that the economy is slowing down. You may have a different opinion. So let's start there. Do you?
I think Adam, as you know me, that the way I read the data is I read it as there's a straight up read of the data. You mentioned the negative ADP this week, which everybody is really focused on because there won't be an official BLS report. And when you look at these data, it would look like that the labor market is falling off the cliff. But that's the perception. But there's also the piece that I put more focused on is we just accept that things are not measured always accurately in the world. You try to understand how these things are being measured, and you adjust for what you think are the measurement errors, and you get to the underlying what's really going on. And I think after I do all those adjustments, I think what it is at the end of the day is that I think the worst deceleration is over, and we are kind of in that right after the worst, kind of where the economy is trying to recover, is recovering somewhat, but it's still a very fragile kind of recovery. And looking forward, I mean, if I have to summarize why my view has become more bullish as opposed to having been bearish for, most of the last couple of years, I think it's because the economy actually had been slowing and decelerating for the past 2 years. And finally, we are at a point where most of these policy headwinds are over. Policy uncertainty has diminished. The Fed is ready to cut. Fiscal is also turning positive next year in terms of the impulse. So all three major economic force that's shaping the economy is turning in a positive direction. So I think that that is one reason why I think the direction is an acceleration in economic growth from here on.
Okay, I want to dig into all that. I'll give a nod too that I'm hearing some similarities in what you're saying. with Michael Kantrowitz from Piper Sandler, who I just had on the channel here like 2 videos before this one. So it's interesting, maybe pattern now I'm beginning to see here. When you say the fiscal impulse is going to turn more positive next year, are you talking globally or are you talking US only? And if you're talking US only, tell me why you think the fiscal is going to get bigger than it is right now.
Yes, I'm talking about US only. So it is the uh, rate of change in the deficit that drive GDP growth, right? And that rate of change is that the deficit is going to get bigger next year from the one big beautiful bill. So outside of the extension of the Tax Cuts and Jobs Act, there are additional things where the One Big Beautiful Bill is actually expanding the deficit. For example, the no tax and tips, or the mega baby accounts, or no tax on retire certain purchases for retirement retirees, and so there are, and a lot of these stuff will happen through tax rebate in April. So next April is where, well, people suddenly have more cash,
Hmm.
and then also at this point, the stock market is creating a positive wealth effect for the top 20% by household income in the U.S. economy, and those are driving the consumption, the spending. We just saw yesterday that the car sales number is really strong, exceeding consensus expectations. That is just not something that a recessionary economy does. In fact, I can list a whole bunch of stuff which I'm seeing in the data, which is not how a recessionary economy behaves. So,
All right. I definitely want to pull that thread, but real quick, just a question that maybe some others are wrestling with the way I am. So yes, fiscal spending stimulates the economy. It comes with its own costs, though, right? Unless you truly are from the Dick Cheney school of economics, where that deficits truly don't matter. Um, so more deficits equals good news next year, and kind of what I'm hearing you say. Where is a line where too many deficits become a bad thing?
I think the line is where there's no foreseeable end to it, to this fiscal spending. So this bill, One Big Beautiful Bill, the scoring of this bill has been controversial, right? So if you look at the entire plan, the Republicans says that the spending part of this bill would be front loaded between now and 2028. And most of the part where they're taking away the funding to pay for this front loaded spending and tax cut is in after 2028. So when you score it across the 10-year period, which is how CBO scores it, it actually is paid for by the tariff revenues. So as a result, when the market participants look at this and they look at the tariff revenues, they're like, ah, it's paid for. And so they're not as alarmed. And that's why you see the longer end of the Treasury yields, they're not blowing out in response to the One Big Beautiful Bill. If anything, the longer end of the yield curve has been dropping in the last couple of months ever since this bill is passed, because clearly the market is troubled by other things, which is the cyclical slowdown, the perceived
Mhm.
cyclical slowdown of the economy. And that so the behavior of the longer end of the yield curve are still more influenced by short-term behavior of the economy as opposed to worries about fiscal sustainability.
All right. So is it, I'm wondering if it's too early for you to say definitively, but did Trump's gambit work? Hey, I'm going to shake the global trade chessboard and I'm going to put tariffs on everybody and I'm going to push this big bill through and I'm going to ask to get rid of the debt ceiling and all that stuff. But trust me, everybody, it's not going to be inflationary. It's going to pay for itself. It's going to boost the economy. Does it seem like maybe that's actually starting to prove out here?
Wow, you're putting me on the spot right here, Adam. But
I
So
know. Well, I know. Sorry.
for your long-term viewers, they probably have heard me say that in the very beginning that I didn't think that the Trump tariffs would be as inflationary as most people think.
Hmm.
I also think that most of it would be absorbed through profit margin. And I also thought that the one big beautiful bill would be paid for by the tariffs. So I have said all that before. So in that sense, I'm not surprised, but I know the consensus have been surprised by this. But at the same time, I would say that I would offer more nuances to whether we can definitively say that Trump's gambit has worked. First of all, tariff pass-through, just because firms have tried to pass through those tariffs and have failed now that they're offering discounts this year, doesn't mean that they won't try to pass through again when the economy is in better shape and they have
Right.
more pricing power. I think the part where many forecasters miss is to think of tariff pass through as a static one-off thing, which is like regardless of what's the condition of the economy. My argument has been the economy has gone through a significant contractionary income shock in the last 6 months. There's no compensating, offsetting positive demand shock, just negative demand shock. And as a result, firms don't have pricing power to pass those tariffs through. So suppose now the Fed is cutting rates, and if Steve Myron has his way, the Fed will keep cutting. And in this case, the economy will do a V-shaped recovery, I think, because there are still a lot of pent-up investment needs. And this is coming from AI-related stuff, but also a lot of small to medium-sized business also are they also have not been investing in the last couple of years, and there's just a lot of pent-up needs to do this. So once interest rate falls and uncertainty falls and there's fiscal a tailwind, I think this is where you'll see that firms' pricing power will return again next spring, and then they might try to pass through again. So not it's not just we're going to see a V-shaped recovery. I also suspect we are going to see a V-shaped inflation contour along with this recovery, just because there's also pent up needs to pass through, and it could be that we will be seeing some of that next year.
Okay. There'd be a ton of threads I want to pull here. I'm trying to figure out which one to pull first. So you said a V-shaped economic recovery. I have also seen in some of your recent tweets that you've said it'll be a V-shaped economic recovery or a K-shaped economic recovery. When you say K-shaped, are you talking more sort of like Michael Kantorowicz, a bifurcated economy, part of the economy does real well, but
Yes.
the other part doesn't?
Yes.
Yeah.
Yes, and I apologize for this cape shape, unintuitive characterization of it. Yeah, what I just meant is a bifurcated. You have some that are going V shape, and you have some that are just sputtering around.
Okay, and back to the V shape, not only do you see that potentially happening in the economy, V or K, but you see inflation basically picking back up next year for the reasons you just
Yes,
mentioned.
yes.
Okay, and there will be implications for the bond market for that, correct?
Um, I will have to punt on that one because I think
Okay.
it's more complicated than that, and I'm not a bond strategist. So I will just I just think that it's true that inflation will come. I would think that inflation will be on a, rising through three. Core PCE deflator will be rising through 3.1% through next year. Um, I think whether that affect how bond traders price things is in their interpretation of whether this is a transitory increase in inflation, as the Fed seems to be becoming more inclined to view it, Or has that increase in inflation be just reflecting uh, an anchoring of inflation expectations? If it's the latter, then bond prices will fall to reflect higher yields in the longer term. But if it's they see it as transitory, they would just wave it off.
Okay, and maybe let me ask this question a little bit more specifically. So, not everybody, but a number of the people I talk to think that bond yields will come down next year, either because they see the economy continue to slow, so they don't see the same V-shaped recovery that you see, and so it'll just be, slowing economy and whatnot, and that'll be disinflationary. Um, so, and then you also have the administration kind of trying to do everything it can to get borrowing costs down as well. So I guess my question for you is do you think what do you think the odds are of bond yields heading sub 4 down into some level that the administration would like to see them at? Would they be challenged by this V-shaped bounce in inflation?
Yeah, I think it would be driven more by growth, how the market perceive growth. And if most, so now that many market participants are having more doubts about BLS data,
Hmm.
um, everybody is taking a more holistic look at the macro data, right? So we have in Bloomberg Economics, we have a growth surprise index that takes into 66 indicators to look at the direction of economic surprise. So I think that this economic surprise index is going to keep moving up. And what that means is that as long as that happens through next year, everything else is moving up. I think the market would probably uh, believe that, in fact, growth is still, the US economy is still growing at a at potential pace or even higher than potential pace. There, there'll be one outlier though, in my vision of what happens in the next year, which is the labor market data. So you
Hmm.
could have very uh, great growth data, but you could have a jobless recovery. Recall we have had jobless recoveries before. 2008 was a jobless recovery, 2001 was a jobless recovery. And I think part of the reason why this recovery is this K shape where it's bifurcated is on one hand, in the labor market, what I'm seeing is that big firms are not hiring. They are fixated at boosting productivity. They want to do cost cutting to free up resources to invest in the next generation of technology.
Hmm.
So big firms account for a large proportion of non-farm payrolls. The survey that provides that calculates the BLS non-farm payrolls has over 60% of large firms accounting for the payrolls, right? Whereas in and so as a result, if large firms are not doing much hiring, you could see this in the aggregate number. But what I'm also seeing is that small to medium-sized firms are now hiring. And so tomorrow we are not getting our usual September payrolls from BLS. However, I can see that we are seeing this bifurcated pattern in terms of hiring. And what that means is that productivity is also improving significantly at the large firms level. And with the small to medium-sized firm, their hiring I think suggests that there's some early cycle dynamics happening. These small
Hmm.
to medium firms have really had a very tough time the last 2 years. They also were not really able to hire back in 2021 when the labor market was really, really tight. Only the large firms then were able to hire. And so now that the labor market is loose, the small and medium firms are coming in. And I think that that represents that they do have a more optimistic of the prospect for the future, and that's why they're hiring today. And that's why I think that's one sign that I'm seeing of this early cycle dynamics.
Hmm.
And so you could actually have, given that given that it's the large firms that's not hiring, and that leads to productivity boost, you can have a situation where growth is great, labor market numbers are not great. However, stock market could keep going up because this means that the large firms' profits are going up, and you could have inflation going up despite the productivity boost because this is a service-oriented economy. 75% of CPI is related to service. And when the stock market is doing well because of the productivity boost from the large firms, the top 20% by income would be spending, and that is what drives CPI up.
Right. Okay. Gosh, it's hard not to hear this as if you're somebody who's been frustrated by this K-shaped recovery that we've been in since COVID, it's hard not to hear this as sort of like the beatings will continue until morale improves, meaning the top end of the K is just going to keep doing well and better, and the bottom half of the K may not, right? I mean, it's nice to hear that maybe these smaller companies are starting to hire here, but if these other companies do great, if inflation still picks up, that's going to be felt much more so by the bottom part of the K, and those folks don't own a lot of assets that are getting overinflated. So do you have any concerns that, yeah, this might look great on average for the economy and the stock market, but on the median level, we're still, falling behind?
Yeah, and so the way I would document what happened to inequality over the last 5 years is that I think the pandemic was actually a great flattener because of the fiscal and the fiscal spending, the American Rescue Act, CARES Act, all those fiscal stimulus during the pandemic was to give the bottom 50% more money, right? So in the first 2 years of the pandemic, in fact, inequality decreased because the the people in the bottom half are getting more transfer, and I think that that's really the core differences between the policymakers who think that government spending through increased transfers is great for progressive ideals because you are giving more money to the bottom, raising minimum wage and giving stimulus checks, child care credit, all that stuff. But I think what it showed is in the long term, all those policies become inflationary. And this is what
Right.
we start seeing in post 2022. So I would trace today's the sticky part of the inflation that's related to services uh, um, to that, those policies from 3 years ago, from 5 years ago. And right now, so now after a temporary truce in rising inequality because of the pandemic, now inflation has been biting, and that is a very a force that tends to worsen inequality because here then the real income of the lower 50 start to see erosion, right?
Right. And
And
sorry,
I
sorry
think
to
it's
interject, but just to add that
yeah.
not only have we seen inflation and cost of living, but we've seen price inflation in financial assets. So as much as the bottom half has been getting hurt by the cost of living increase, the top half has been getting lifted by the asset price inflation.
Only after 2022. See,
Yeah.
so there's a story. So after 2022, the asset prices start inflating again because the Fed is close to finishing with this tightening cycle. Recall in 2022, stock prices fell by 20% when the Fed
Yep.
started, right? So before the Fed started raising rates, it was great for this bottom 50, and after that, it was not. And whereas the top income bucket people start to experience asset inflation. I think this 5 years is a lesson for policies, many policies with good intentions of transferring money to the bottom ended up hurting them. And because what needs to happen in order to quash inflation is that the Fed needs to raise rates, and if the Fed in this case also is having good intentions too. I mean, 5 years ago, the Fed changed its framework to now include inclusive full employment, right? And by inclusive, it started targeting these uh, uh, minority populations, their unemployment rate and all that stuff. And that's why they decided they need to run the labor market hot. But now we have seen that when you run the labor market hot and there's overall inflation, it actually hurts the people who they're trying to help in the first place. So I think both the Fed and the federal government, the direction of the fiscal spending of the federal government, ultimately backfired, and we have seen fully the consequences in the last 3 years.
Kind of proving Reagan's point of the most dangerous words to hear, I'm from the government and I'm here to help.
I felt scared when you just said that.
All right. So in talking to Michael, kind of like you, there's a lot of similarities. He's seeing some green shoots in growth, and I do want to acknowledge that the date we're talking, the Atlanta Fed GDP now estimate for Q3 is like 3.9%, right? I mean, that number will bounce all over the place, but it's looking good so far. He said inflation is moderating, which is good, and that rates are poised to continue to go down from here, especially at the short end with the Fed cutting. And he actually says that he's sort of saying these are becoming Goldilocks conditions for a recovery. And he said one of these Goldilocks elements is actually the weakening jobs market. He said if the jobs market is weak, that provides the Fed with air cover to come in and cut rates, and that will be stimulative to the economy. And as long as the job market doesn't get too weak, right? Then it should be good, right? And the other factor he added in here too is low oil prices, which undoubtedly have been helping the situation. Do you agree with his point there about like enough weakness is good, quote unquote, good for the economy in the job market as long as it doesn't get too weak?
Yeah, I read Michael's note last night, and that he just recently put out a very insightful note, looking at historical episodes where the unemployment rate would rise with stock market. Because the question is, can the stock market keep rising when the unemployment rate is rising? And most people have the most recent recessions in their mind when they thought about it, 2020, 2008, and 2001. And based on those three, you would think, no, the stock market would go down if unemployment rate goes up. But Michael showed that, in fact, there are many other historical episodes where the unemployment rate would go up, even as the stock market would go up. And I looked at those episodes that he identified. And what I found most interesting is that those episodes are the so-called soft landing episodes, or the ones where, so this is what you probably mean by Goldilocks. How Goldilocks can the labor market be in order for the stock market to go up while unemployment rate is also going up.
Increasing.
And
Yep.
and those episodes include the 1950s, the 1960s, the early 1970s, and 1982. And the commonality of those episodes is the lack of resolve of the Federal Reserve. And so basically, the Federal Reserve in those episodes didn't finish the job in quashing inflation. They just kind of like raised it, but the labor market started weakening. They immediately start cutting rates. And in fact, even the 1982 one, you would think that, well, Paul Volcker was at the helm of the Fed. So how is it that, in fact, why isn't, why is the stock market going up? Because even recall that there was a double dip in the early 1980s. The first time around in 1982, Paul Volcker saw that the labor market is deteriorating, and he wavered. And so that recession was cut short really quickly. And it's only later on where inflation flares back up that he decided to go, really all out, right? Right. So,
Mhm.
so I think that today's Fed is behaving very similarly as those episodes that Michael Cantrell has identified as where unemployment rate would go up with the stock market, in the sense that today's Fed seems to be kind of relaxed about the inflation target. The Fed is supposed to be targeting 2%. They have been off the target, above the target for almost 5 years now. And according to the projections, they would be above the 2% target even out to 2028 for 8 years. And as you could see in their behavior recently, the labor market deteriorated a little bit and they're immediately jumping into action to cutting rates. And so I think that, so my own estimation of the Fed's reaction function is that they have shifted in a dovish direction, is as if they're targeting 2.8%, as if, I mean, acting as if they are doing that instead of the 2%. So I think there are, in this sense, a very important piece of that can govern the macro direction in the next year is what the Fed will do. And given the more dovish shift in reaction function, I think the Fed will accommodate the labor market. And so there's a likelihood that higher likelihood that Mike's optimism is well placed, I think,
Is well
based
placed.
on the read on the Fed alone.
Okay. And let me ask you this. One might say, well, look, if the economy is starting to strengthen, then why are we cutting into that? Why don't we let wouldn't that maybe in danger of eventually getting the economy overheated and returning inflation and all that stuff? I did hear you say that this is sort of a fragile economy here. So I guess my question for you is do you think the current Fed approach strategy to cut from here is appropriate given the conditions on the ground?
I think given what they're seeing in the data, they might feel like they should do this because we just got a negative ADP data, right? A negative 32,000, shockingly weak. And the last 2 months of NFP from BLS also have been surprisingly weak. So based on what they're seeing, I could see why they probably want to buy some insurance with cutting. And also it fends off some political heat from Donald Trump, right? However, if going to the point that I made at in the beginning of this podcast, I mentioned that if you adjust for the measurement errors, what I'm seeing is that in fact things are looking better than what the ADP is suggesting,
Right.
and that there is actually some rebound. So I'm seeing the momentum of the labor market actually improving. And I'm seeing also that there's a lot of pent-up AI related investment that needs to happen the moment that the Fed lowers interest rate. There are just a lot of impulses that's been bottled up. And, going back to 2021, that was also what I saw back then. The reason why that inflationary wave came so fast was because there was actually a lot of bottled up stuff before the pandemic, that bottled up demand that wants to happen. And so hence it was so inflationary.
Okay, but just to ask my question again, is it I know you think from their own point of view, the Fed thinks that their strategy is appropriate, but from your point of view, in terms of a recovery economy that should continue to strengthen from here, is cutting warranted right now?
So from my perspective, is different than the Fed's perspective, only because the Fed has also need to be mindful of its institutional independence, right? So the Fed's risk management objective, while they wouldn't admit it, probably incorporated some considerations of political independence.
Hmm.
And so whereas from my perspective, I I'm just thinking if I were purely based on what I'm seeing in the economy, and what I'm seeing is that if they cut very sharply, the inflationary pressure will flare up. So it's
Hmm.
not appropriate.
Okay, great. That's where I was going. Thank you. Um, all right, let me I want to ask about, what are some curveballs? Like what are given that maybe growing optimism, are there curveballs you're worried about that could derail this? But before we get there, I want to pick up a conversation that we had, I think the last time you were on, because I've cited it an awful lot, and I'm curious if your thinking on it has shifted. Um, I remember, and correct me if memory is incorrect, but I remember that you were kind of concerned about the implications of the student loan debt going into repayment, because that's the one kind of debt you got to pay. You decide not to pay it, the government's just going to take it out of your wages,
Mm-hmm.
right? A substantial amount of borrowers out there, a substantial amount of them clearly can't even repay these things right out of the gate. And we saw delinquency rates shoot up, right? And we're going to see defaults start to shoot up as a result of that. But we're seeing this danger of sort of a contagion spreading into other types of consumer debt, right? As you rob from Peter to pay Paul. Okay, I had to pay the government my
Yeah,
student
right,
loans.
right, right,
Now I
right,
can't
right.
quite, now I'm going to be delinquent on my auto loan or my credit card loan, or maybe even starting my mortgages. So we were kind of in the early days of that repayment process. We're further along now. Um, what's your attitude on that now? How big of a concern, if at all, is it for you?
Yeah, I think it is a concern because but whether it has devastating macro consequences, that will more than offset the positive impulses of the economy, I am not so sure. This is the K-shaped recovery, right? You have
Hmm.
this student loan borrowers, which tends to be most of those debt is, I believe, concentrated in the age group in their 30s and 40s, the sandwich generation.
Hmm.
Uh, those and the ones that are going delinquent, particularly, are those who didn't finish the college degree, so they borrowed funds but didn't complete it. Those are the ones most at risk of delinquency. And so I think that segment of we calculated that that segment uh, probably would shaved off up to point at most zero point 0.8 percentage point from personal spending, PCE, personal consumption expenditure.
Hmm.
But what we are seeing offsetting partly that is this wealth effect from the continued stock market um, um, rally, right? And the we just got some new auto purchases data yesterday, very, very strong, which suggests that uh, those people who are benefiting from the wealth stock market are actually filling the gap on those people who are pulling back and spending from student loans.
Okay, so you've probably seen the same charts I have of, like, the top 10% is makes up about 50% of all consumer spending, and then the bottom, I don't know, the next 20 to 50% makes up the next big chunk.
Yes,
And then the remaining 50 or remaining 60 or whatever it is, pretty small percent. I hate to
yes,
say.
but I think the issue that one should be concerned about is from the financial stability perspective, which is that of these loans, suppose that the delinquency spill over to credit cards,
Yeah.
and or it also spill over to manifest itself in some bankruptcy of some non-financial firms that turn out to be carrying all these consumer debt in their balance sheet, and those consumer loans in terms were repackaged into other type of uh tranches of loans, kind of like
Right.
2008, right?
Yeah,
that
that's the
that you
contagion I
don't
was referring to. Yeah.
Right, that you don't know where these bad loans are until they turn bad. Because I could not tell you which corner of the financial system are these exotic things in. And until then you realize, oh, there's contagion, right? But in terms of a macro, how whether directly are they a macro headwind, it's not obvious they are. Only if it becomes a cascading financial stability issue, which is hard to tell a priori. That's the job of bank supervisors. Until then, I would just say my baseline is so far that is not having a visible impact on macro aggregates.
Okay. All right. That's good to know. And again, just to make sure I heard you right, it sounds like that top 10%, top 30%, whatever, they're increasing their spending enough. Um, because of the wealth effect, that it's making up for any reduced spending of the really strapped people below the line. So you're not seeing it as a macro threat, like you said, but you're open to the fact that there could be a credit risk if some of these lenders get overextended, and then we find out that people who depended on them are exposed as well. But we won't really know that apparently until the bodies start floating to the surface. Which, by the way, we did have a couple recently. We had Tricolor and
Yes.
another firm, right?
Yes, yes, yeah. And also, Adam, at the end of the day, I think the most important driving force of the economy is the policy, right? Even if there's a credit event, what matters on whether that will spill into a hard landing event is the reaction of the Fed and the Treasury or other policymaker. If the Treasury bails them out, if the Fed unleashes liquidity lines, so to backstop the frozen credit in the
Mhm.
market, no problem. So it's really about the policy response.
Okay.
And
And sorry, so sort of
right,
like what we saw with Silicon Valley Bank and the other banks that failed, right?
exactly.
A very
Right,
swift response, right? Yeah.
right, exactly. So if the Fed is very ready to step in, no problem.
Hmm. Okay. Of course, it's hard for people not to hear that and just think, okay, too big to fail, and bailouts for anybody that was a bad actor is just going to continue to be business as usual.
Yeah, I'm not. By the way, I'm not saying I think what the Fed is doing it would be right. I'm just saying, as long as they're doing that, then you could keep seeing this party go on and on.
Go on. Okay. All
And
right.
and I
Go ahead.
and Adam, sorry, just to be
No,
clear,
please.
Michael Cantro's view that the party can go on. Again, let me stress, it's conditional on a very accommodative Fed. If the Fed decides to say, suppose that Donald Trump suddenly appoint Kevin Warsh as the central bank chairman next spring.
Hmm.
Kevin Warsh is a very hawkish person. He's like a persistent hawk, and an inflation hawk. He even was worried about inflation in 2010. So if you have somebody like that leading the Fed, it might be a completely different situation. My baseline is that the Fed will be populated by people who are more inclined to accommodate any labor market weakness.
So that's really interesting. And again, I should remind the audience that you used to work at the Fed, I think.
Yes,
No, okay. Did you work at the Fed? Oh, yeah, you did. You worked at the
yes,
Federal Reserve Board. Yeah.
yes.
Okay. And the Treasury and the White House Council of Economic Advisors. So, you really know systemically how all this works. Um, but yeah, on that point, I mean, I know that Warsh has been one of the lead horses for a while. I don't know if he still is or not. I know that there's a tremendous amount of respect for him, but I would definitely say the storyline right now, the dominant storyline, is that Trump is trying to pack the Fed with, doves and people that'll do whatever it takes to get the policy rate down as low as possible. Um, and presumably, help the administration intervene on the administration's behalf whenever it needs it. Um, I think you said your default assumption is that it'll be a more dovish Fed going forward. But how accurate do you think that current storyline is? Or maybe the other way, what probability do you give Trump maybe surprising everybody and putting in somebody like a Warsh?
Uh, it really it is when you look at the Fed history, it certainly is not at all obvious that a president who tries to influence the Fed by appointing somebody who supposedly is dovish, that person will act dovish. For example, in the 1950s, when um, Chairman Echoes was demoted in favor of somebody who President Truman thought would be more inclined to monetize fiscal debt. Well, it didn't play it out that way. The next two people that Truman installed, McCobb and Martin, turned out to be the father of Fed independence
Hmm.
thereafter. And I believe, do you remember who which president appointed Volcker. Was it Jimmy Carter? I think so. Yes, Jimmy Carter appointed Paul Volcker. But Jimmy Carter was the president who oversaw this whole period of unanchored inflation expectations by pursuing Keynesian policies and a lot of the policies that were very inflationary. And yet he got us Paul Volcker. So I think that if Kevin Hassett were to be appointed the Fed chairman, I right now I think that Kevin Hassett is actually a very open-minded person. He also used to be at the Fed. It's not obvious to me that he's the boogeyman uh who's so loyal to Trump that he would just keep lowering interest rate even though inflation is flaring up. Um, Similar with Stephen Myron. So Stephen Myron, yes, he has pushed for very low interest rate recently, but at the same time, from what I've read of him and what I know of his argument, how he thinks in the last couple of months, I also think that Steve Myron is a very intellectually very flexible individual who I mean, they're both there to serve the country. If they see inflation flaring up, I think they will do the right thing. Maybe I'm in the minority here.
Well, we'll see. And, I mean, we even have
I mean,
recent evidence.
to be clear, they might see they Kevin Hassett, Steve Myron, and any Trump appointees, like even Chris Waller, might be perceived as just kowtowing to Trump by pushing for lower interest rate. But the truth of the matter is, there's an institutional bias within the Fed to favor, with a groupthink, to favor uh, Keynesian policies, so policies that tend to be favored by Democrats. And in fact,
Mhm.
as you probably know, the donation record within the Fed is like 90 over 95% Democrats.
Democrat.
And
Yeah.
and so it's actually in my mind, I think it's actually healthy to introduce these diversity of views uh just to stimulate a debate, right? So clearly, Steve Myron's argument did not move anyone at the FOMC. However, it steered the conversation. It opened up the range of the debate to consider cutting, whereas before there was not even it was like a small range of policies to be considered. Not, but right now he just opened it up, and I think it's a healthy thing.
Okay. No, that's actually really fascinating. And like I said, to your point about sometimes the Fed chair just doesn't do what the president who put him in assumed he would. We only have to look at Trump's first
Oh
administration when he
yeah,
put
yeah,
Powell in.
exactly.
Yeah,
So every time the president tried to put somebody in who they thought would be friendly to the policy, didn't end up that way.
yeah. So okay. All right. Well, look, we're coming up near the hour, so I've got to wrap it up to be respectful of your time. I've got one curveball question for you, but before I ask it, to set the context. Okay, you see a potentially recovering economy from here. Um, what kind of market outlook do you have at this point in time? Does that de facto mean good market next year because of a recovering economy, or will the two perhaps be as less correlated?
Sorry to disappoint you, Adam. I'm not a market strategist. I'm an economist, so I
Yeah.
have to refrain from giving market advice. But generally, I think I agree with Michael Cantrow's hypothesis. I think there's something there.
Okay. And just to refresh people who haven't watched that video, Michael's market outlook is this is all generally pretty good for the markets, and he thinks it's healthy in the sense that he sees a broadening out of the sectors of the economy that are starting to get some love because of late it's really just been the high tech capital investment part of the economy that's gotten a lot of benefit. And now we're starting to see other parts of the economy start to get some sunshine and hopefully fare better from there. So he thinks that in general the market will do okay, but it probably won't be the big tech hyperscalers driving all the growth going forward the way they have for the past couple of years. He thinks they'll probably still do okay, but he thinks the better returns will be elsewhere in the market. It'll be sort of in the lesser loved parts of the stock market that hadn't been getting much sunlight. So the smaller cap stocks and even a lot of the S&P 493 outside of the Mag 7. So he said, you're probably going to find better returns as an active investor next year, investing in these areas that are starting to really recover. Probably more so than you will if you just try to ride the existing big tech trend that's been going on the past couple of years. You don't have to agree with any of that, and I just wanted to make sure folks knew what Michael's current outlook was. So let me ask you this then, and it's a market related, but I think you can still have a opinion on it as an economist. So much of the current market valuation right now is around AI. And if you look at the market valuation metrics, a lot of them are at all-time extremes, or close to it, or in some cases, definitely at. And so to a certain extent, were something to happen to the AI phenomenon, that would definitely have a pretty big market implication, and it could actually have economic implications from the negative wealth effect that would follow. And we're seeing, I mean, almost like a week doesn't go by now where somebody who's really high up in the AI ecosystem saying, this thing's in a bubble. So do you have any concerns about kind of an AI correction, maybe sort of similar to the dot-com correction, where it's like, look, we're not saying the internet isn't going to return phenomenal returns over time. It sure did. It just didn't deliver them on the immediate scale that everybody was assuming in 1999 to support those asset valuations.
Okay, I will answer this question in two ways. Number one is, since my specialty is in macro, I'll focus more on the GDP and growth implication. So what we are seeing in GDP figures in the last year is that AI-related investment has supported GDP growth by about 1 percentage point in the first half of this year. So without the AI related contribution, it would have been, this first half of this year would have been zero, close to zero, right? And so in this, the AI related capex is just this is just the beginning of it, as it shows up in GDP. Last year we didn't see it this clearly. Only starting in the first quarter are we starting to see it clearly. So what we try to answer is, could the AI related capex grow at this current rate? So it has to keep going at this rate in order for it to keep contributing so positively to GDP growth. And the answer we arrived at is likely yes, until next year at least. And why is that? Well, it's because we interpret the dampening of this AI-related sentiment recently as related to people are more clear-eyed about the feasibility of AI and becoming, well, in their AI is not going to be sci-fi, reaching that sci-fi level that people had in their fantasy. It's
Mm-hmm.
going to be much slower. However, the second phase of AI would be the adoption and usage in other applications, right? And we think that this second phase is as data center intensive and energy intensive, can support that level of investment in order to continue to add to GDP. And we are seeing still shortages in data center and electricity power grid. And given that shortage, it means that there's positive incentive for firms to be investing. And so from a macro perspective, we see a case for continued investment related to the infrastructure of AI, right? So that's part one. Part two, in terms of the market, which part of the AI market is huge, right? There's the hyperscalers, and there's a whole bunch of small caps and mid caps who are increasingly adopting AI, right? So is the bubble in the hyperscaler, or are we talking about a bubble in all the AI related stocks out there? And again, I'm not a equity market specialist, but how I would apply economic reasoning and intuition to analyze this question is, basically, there is an AI-related stock bubble if the profit margin growth of these AI-related firms are not on a path for their to break even in their EPS, right? A bubble like the dot-com bubble is one where you see a lot of firms who actually have negative EPS who are not making a profit yet fetching sky high valuations, right?
Mhm.
But right now, what you're seeing in these many of these small caps AI related firms is increasing, accelerating profit margins. So it's not like the profit margins is tanking yet. It's like you're seeing like 60, 70, 80% profit margin. And so they are actually, some of them are on track to break even the EPS. And I think I would I would advise for those who are trying to gauge what stage of the AI bubble, or if there's a bubble, is to calculate the break even of the profit margin for breaking even EPS and look at the path of the actual profit margin of these small caps to medium caps, mid caps AI related firms, and see whether they're on track or is it really ridiculous.
Okay. Well, it's a great economist answer, and certainly what I take from part of what I take from your answer there, Anna, is there's some there. Question is there enough there to support today's asset valuation prices? But TBD, and do your homework, as you're saying. All right. Well, look, as we wrap up here, is there anything burning brightly on your radar, either as a uh, an opportunity or a concern that I haven't thought to ask you about yet?
Adam, you've always asked the most important questions, so you got it all.
Ah, you're so kind. All right. Well, there is one last very important question to ask you, Anna, which is for folks that have really enjoyed this discussion and would like to follow you in your work in between now and your next appearance on this channel, where should they go?
So you can follow me on my Twitter account at Anna Economist, or you can find our work on the Bloomberg terminal by typing BECO Go, where you can access all our coverage of the global economy.
All right, fantastic. And as usual, Anna, when I edit this, I'll put those up on the screen so folks know exactly where to go. Folks, the links will be in the description below this video as well. All right, well, folks, please join me in thanking Anna for coming on the program and being so generous with her insights by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Also, this video will go live on Sunday, and I believe this is the last day that, maybe it's the day before the last day, that the early bird lowest price discount we're offering for our upcoming fall online conference will be available. So please, if you haven't bought your tickets yet, buy them now so you can lock in that lowest price. To do that, just go to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, look for the code that I've emailed you that you can use to get an additional $50 off of that lowest price. But yeah, do it soon because that conference is coming up in just about 2 weeks, and it's going to be absolutely fantastic. Best faculty ever. Lastly, if you would like to get some professional help in figuring out how to position your portfolio to ride the trends of the future, especially if they happen the way that Anna thinks they might from here, then I highly recommend that you get that advice from a good professional financial advisor, one who takes into account the macro issues that we talk about here at Thoughtful Money. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you just like a second opinion from one who does, consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com, and the firms will be in touch with you shortly. Again, these conversations are totally free. There's no strings attached. There's no commitments involved. It's just a free service these firms offer to help as many people as they can. All right. And with that, Anna, again, it's always such a pleasure. Thank you so much for coming on.
Thank you, Adam.
All right. And everybody else, thanks so much for watching.
Central banks are making out of US dollars and out of US treasuries into gold. And that has been the primary driver of the gold bull market. And gold has outperformed the S&P so far in the 21st century, 25 years. And this is going to accelerate. And not only is it going to accelerate among central banks, but institutional investors and retail investors are going to finally start to participate. So, you know, a $10,000 gold price is not that far off. You know, it's only about a triple from here. But you know, I think it could easily be done over the next, you know, maybe 3 to 5 years.
Central banks are set for a fourth straight year of heavy gold buying, with around 1,000 metric tons expected in 2025 as they shift away from dollar assets amid U.S. policy and geopolitical risks. In Q2 2025 alone, they bought 166 tons, 41% above normal levels, showing the urgency of this move. A World Gold Council survey found 95% of reserve managers expect gold holdings to rise in the next year, with 43% planning to add more, while many see the dollar's role declining over the next 5 years in favor of gold, the euro, and the yuan. Peter Schiff is a well-known economist, investor, and financial commentator, highlights that gold miners have surged over 50%, far outpacing bullion's 25% gain, with ETFs like GDX and GDXJ still trading at low valuations despite strong earnings growth. A Reuters poll sees gold averaging $3,220 in 2025 and $3,400 in 2026. Silver is up 32% this year, nearing $40, its highest in 14 years. He mentions that the S&P may be up about 10% this year, but with the dollar down the same amount, international investors see no real gains in U.S. stocks. In contrast, this performance gap signals a shift of capital away from the U.S., as both foreign and American investors redirect money abroad. Gold and silver mining stocks have been standout performers, up nearly 80% and on pace to possibly double this year, outperforming tech, crypto, and every other sector, yet largely ignored by mainstream media. Looking ahead, while developed markets like Europe and Asia have led in 2025, emerging markets remain undervalued and could be the big story of 2026. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
Well, I mean, look, the inflation is going to erode away most of the investment returns. Yeah, the S&P 500 is up 1.5% today, but the dollar's down 1%. So, you know, it's really only 0.5% if you measure it in other currencies, and that's how investors around the world are looking at it. But meanwhile, foreign stocks are doing a lot better. Look at gold stocks, which, you know, gold stocks are up another 2% on the day, but they're up 77% year to date. That's the GDX and GDXJ. And, you know, so this is indicative of, you know, the Fed being too loose. And, you know, gold is up today, but it's still, you know, below 3,400. Silver is now back above $39. But I think silver is getting ready to blow through 40. And I think gold's getting ready to blow through 3,500. Well, the economy is not booming, and nor is it going to boom at all during the Trump years. But in order to cure the problems that he inherited and that he contributed to during the 4 years he was president, right? He doesn't come to this thing with clean hands. But in order to fix the problems, we actually need a bust, right? We need the bust before we can have the boom. Trump wants to skip the bust and go right to the boom, which you can't do. All you can have is a bubble. So rather than have a legitimate economic boom, Trump just wants to inflate another bubble so he can pretend that the economy is booming, even though we're just blowing air into a bubble.
Yeah. And so you mentioned a bust. How bad could this bust look? Like how bad could it be?
Horrific. I mean, much worse than 2008. I mean, we have a huge debt bubble, and when it pops, you know, there's a lot of disaster in its wake. I mean, there's going to be a lot of defaults, a lot of bankruptcies, a lot of failures. Look, stocks are going to crash, bonds are going to crash, real estate's going to crash. Look, a lot of bad, painful things have to happen to fix this problem. That's why the problem's not going to get fixed, because the politicians don't have any stomach for that pain, because it might mean that they don't get reelected. And of course, that's the only pain they care about is their own pain. And so they're going to kick the can down the road with another sugar high. And that's the Fed is now cooperating, cutting rates. By next year, you know, they'll be in QE mode. Yeah, well, I think the S&P is maybe up around 10% this year, which is about how much the dollar is down. So if you're an international investor, you're looking at no return on U.S. stocks. Meanwhile, I look at my mutual funds. I have 5 mutual funds. One of my mutual funds is called the Euro-Pacific International Dividend Payers Fund. And we buy dividend-paying stocks outside the United States. So, higher dividend-paying stocks. So typically, these are more conservative type stocks. So they're not growth-oriented. We're buying them because they pay good dividends. Well, that fund, year to date, is almost up 40% now. 40%. Now, yeah, about 10% of that is foreign exchange related. But still, that is, a huge performance gap. I mean, basically, we're making 4 times the money investing in foreign stocks as we would be investing in the S&P. And that is a big signal to capital allocators around the world to jump on board this train. And so I think you're going to see a lot of money leaving the U.S. markets. Money that has been sucked into the U.S. markets for the past 10, 12 years is now going to get sucked out. And that means foreigners who have U.S. investments are going to sell their U.S. investments and bring their money home. But then Americans are going to sell their U.S. investments and send their money abroad. And so that's what's really going to be helping. I mean, my asset management company, Euro Pacific Asset Management, because that's what we specialize in. And again, gold stocks are up now close to 80% on the year, 77% for the GDXJ. This is the best year on pace that I can remember. I mean, there may have been a better year in the early 1970s, mid 1970s, but this I think is the biggest single calendar year that I can remember on pace. Because I think we could finish the year where the GDX and GDXJ, these are indexes, double in value, 100% gain in a single year. And gold stocks year to date are the best performing sector, gold and silver mining stocks in the U.S. stock market. They're beating tech, right? They're beating crypto. They're beating whatever. Like whatever you think is the best, it's not. It's gold and silver mining stocks. And they're getting no coverage. If you watch the mainstream financial media, you'd have no clue that these stocks were doing so well. We've been way overweight Europe. And we have investments in Southeast Asia, including Japan. And we have some money in South America and in Canada. But I think we're going to probably be allocating a little bit more into the emerging markets. We have an emerging market fund that concentrates, and the emerging market fund is my least performing fund. Year to date, it's up, in the low 20s, which is still beating the U.S. by more than double. But the emerging markets haven't done as well this year as the developed markets. I think that may change in 2026. So I think we're probably going to allocate a little bit more into the EM for next year, because I think that's going to be a big 2026 story, is going to be the outperformance of emerging markets, because they're still really, really cheap compared to developed markets, and even cheaper compared to the U.S. market. Well, I mean, I think silver's looking pretty strong. I mean, we're just around $39. There's obviously some resistance up there, but if we can break through it, I mean, we're not quite at a 52-week high today. We didn't quite make the highs. But we'll see what happens next week. I mean, I know that these metals are basing, but silver is very cheap. And so I've been a real promoter recently, last 6 months in particular, even before, when it was 100 to 1, when you could get 100 ounces of silver for 1 ounce of gold. And, it's not quite that cheap anymore, but it's still historically cheap. So I really like silver.
U.S. assets currently dominate global portfolios, accounting for nearly half of the investable market. However, rising concerns over U.S. weakening dollar returns are prompting investors, particularly in Europe, Japan, Sweden, and Australia, to explore alternatives like gold, Chinese tech, and emerging markets. Risk hedging via currency strategies is gaining traction as the dollar's depreciation erodes dollar-denominated returns. Peter reveals that China still offers plenty of cheap stocks, and with growing weight in emerging market funds, it's positioned to come out of the global trade war stronger, forming deeper ties with Russia, India, Africa, and even Latin America, while U.S. influence weakens. Meanwhile, U.S. tariffs, like the 50% duty on Indian goods, ultimately hurt American consumers and strain foreign partnerships. Commodities are set for a major boom as inflation rises and the dollar weakens. Energy, oil, natural gas, and agriculture all look cheap now, but demand will surge, especially from emerging markets that benefit from a weaker dollar. Instead of exporting to the US, these nations will increasingly produce and consume goods domestically, driving up demand for energy and resources. While this supports global growth, it also means higher commodity prices for Americans, many of whom will be priced out due to the declining dollar.
And so
I think there's still a lot of cheap stocks in China. We have some Chinese exposure in our funds, and especially in our emerging market fund where we're overweight China. But yeah, I think that China is going to come out of this, global trade war as the winner. I think that they're going to strengthen their trading relationships with the rest of the world. They're going to form better alliances with Russia, with India. This is going to be to the detriment of the U.S. And I think they're going to have stronger relationships in Africa, and maybe even in our own back door in South America. You might see that the Chinese gaining additional inroads in Latin America because they're not going to be trading as much with the United States. It's not just that we shot ourselves in the foot. We're shooting ourselves in the head. Put 50% tariffs on India, 50%. Now, again, the tariffs aren't on India. They're on Americans who buy Indian goods. But it still is a problem for Indian companies that wanted to sell American goods because now their goods are 50% more expensive if the Americans want to buy them. Yeah, well, first of all, if countries stop buying oil from Russia, it's just going to make oil more expensive because if they have to buy it someplace else, you're just going to shift the demand and we're going to end up paying higher prices. Ultimately, Russia is going to sell the oil anyway. It's going to get it out of the country. So it doesn't make any sense to put those sanctions on. And all it does is piss off people. Like it gives people another reason to get out of the dollar and get out of U.S. treasuries. Countries don't like being sanctioned. They don't like being pushed around. We wouldn't like it either if some other country was doing it to us. America benefited from other countries using our currency. We got the seigniorage gain. We got artificially low interest rates too, and we got lower consumer prices. But we're pushing all that away. We're, biting the hands that have been feeding us. So it's generally not a good idea to do that. And they also, need to hedge against Bitcoin if they have some of that. That's the stupidity too, because a lot of people in America, instead of buying gold the way they're buying it in India or China, they've been buying fool's gold, aka Bitcoin. And that's been a problem because when the Bitcoin bubble pops, a lot of these people who thought they were buying something like gold, they're going to find out that they weren't. So that's unfortunate because Americans don't own enough gold, either because they own Bitcoin or they own nothing. But owning Bitcoin is basically like owning nothing because that's all you got when you own Bitcoin is nothing. I think energy is cheap, natural gas, oil is cheap, agricultural commodities. I'm bullish pretty much on the whole complex of commodities. They're all going to be bid higher with all this inflation. And especially, as the dollar really tanks, if emerging markets are a main beneficiary of a weaker dollar, then they're going to consume a lot more commodities because, they're going to start consuming more of their own production. Instead of exporting stuff to America, they're going to build stuff and keep it. But I think there's going to be a lot more energy because they're going to produce a lot of things that are more energy and resource intensive when they're no longer just exporting trinkets to America. They're producing goods for their own consumers. So, we could see a real boom in commodities. And of course, this means that commodities are going to be a lot more expensive for Americans too. Just a lot of Americans won't be able to afford to buy them. They'll be priced out of the market.
Central banks record gold buying, weakening U.S. dollar returns, and the outperformance of foreign equities and commodities all point toward a structural shift in global capital flows. Gold and silver miners, alongside emerging markets, are increasingly attracting attention as U.S. assets lose appeal. With inflation, tariffs, and geopolitical realignments reshaping trade and reserve strategies, the next few years could mark a turning point where hard assets and non-U.S. markets take the lead. Could central bank demand alone be enough to push gold toward the $10,000 target? How will the shift of capital into emerging markets and commodities affect long-term U.S. economic influence? Share your thoughts in the comments below. We'd love to hear your perspective. Don't forget to subscribe for future updates, and if you found this content valuable, a thumbs up would be greatly appreciated. Thanks for being part of this journey with us.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates.
With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. Colin Weiss wrote in Official Reserve Revaluations, The International Experience on August 1st. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Noting this scenario, the speaker, Clive Thompson, highlights that the Fed isn't guaranteed to pick a revaluation target of $15,000 per ounce. They might even use the spot price instead. The Federal Reserve published a research note titled Official Reserve Revaluations, The International Experience. The paper examines 5 countries, Germany, Italy, Lebanon, Curaçao, Sint Maarten, and South Africa, that have revalued gold or foreign reserves to bolster their finances. The Fed has not committed to a specific revaluation figure, such as $15,000, using market prices, is still on the table. The study examines how other central banks have utilized revaluation proceeds to offset operational losses or provide government financing. However, the US has yet to take such a step. If revaluation occurs, then this paper profit could be converted into gold certificates and handed over to the Fed. The Fed could then credit the Treasury with new dollars, allowing the government to spend without officially increasing its debt. This is why some refer to it as a hidden financing tool for the state. Central banks have different methods for valuing their existing bullion holdings. Some value their gold reserves at their historic cost, others report it at current market prices, he said. When central banks report their holdings at current market prices, fair value, the unrealized profits or losses from valuation changes are recorded. When gold is valued at historic cost or modified historic cost, gold reserves can be revalued at market prices or values closer to market prices to generate revenues, he noted. When all official reserves are valued at market prices, the unrealized valuation changes recorded in the revaluation account can be shifted to others. Now, we present the clips from the interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
first of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want to, well, they don't want to do a figure which is going to make people panic and say, oh my God, the dollar's worthless because they've done this. So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary. Not much. I mean, let's face it. With the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt. Well, I think if you're buying physical gold and silver in the form of coins and bars, the thought process ought to be one of, I'll keep it forever unless there's no choice. So it's kind of like an heirloom. It's a bit like if you buy a painting, you put it on your wall and you expect to pass it down the generations. Obviously, it's an asset which can fly a little bit under the radar screen, which can be advantageous depending on how you look at it as well. So when I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way, I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you.
Francis Hunt, also known as Market Sniper, points out that a significant revaluation of America's gold reserves could instantly boost the federal balance sheet by recognizing hundreds of billions in previously hidden assets, thereby improving the debt-to-asset ratio and bolstering confidence in U.S. bonds and the dollar. By providing extra backing for government obligations, it could help address record-high sovereign debt, while reinforcing gold's role as an inflation hedge, signaling limits to currency debasement and strengthening trust in U.S. monetary stability. Despite its potential benefits, gold revaluation would likely trigger significant market disruptions. Financial markets have operated for decades under the assumption of fiat currency dominance, and an essential shift in monetary policy could lead to substantial volatility across asset classes. Revaluation might paradoxically create inflationary pressures if implemented too quickly or without careful communication. The sudden recognition of additional national wealth could alter inflation expectations and lead to accelerated price increases in the short term. Major gold holders, such as China and Russia, who have both been actively increasing their reserves, would likely react with deliberate actions to capitalize on a more gold-driven monetary environment if the US were to revalue gold. A comprehensive legal and regulatory foundation would be required for such a change, including congressional consent, coordinated action by the Federal Reserve and Treasury, and a clear implementation strategy. The foundation for this strategy may already be in place, according to recent Treasury remarks on asset monetization. Growing awareness among financial professionals and officials highlights gold's potential as a significant instrument for addressing America's debt issues, although the timing and scope of any adjustment remain unknown.
What does history show us on revaluation conduct? It shows us that government has no interest in making its citizens wealthy. What did they do previously? Roosevelt got everyone out of the metals by decree, by threat of law, massive fines that would run into millions today. It was tens of thousands back then when you bought houses for that kind of money, and multiple years in jail. What did the events of COVID tell you about their approach? They're in it to enrich themselves. You weren't given the heads up of something coming, then everyone's speculating and all jumping into pharma shares. They took the money and they closed your businesses down. What do the possibilities of the great taking tell you? The possibilities of the legalese versus the English show. When you understand where they're seeking to take us, and this is my conspiratorial nature, Clive might think, but we are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out. And I think the option of a mark to market is far more likely. And the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark-to-markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do. But they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax, even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt. And they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors if they do end up giving you a decreed new price that isn't price discovery. There's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality optionality so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
A revaluation of US gold might reveal enormous latent value in the country's reserves, enhancing fiscal stability, fortifying the dollar, and indicating a cap on unrestrained currency production. To prevent market turbulence or inflation shocks, such a move would necessitate rigorous coordination between the Federal Reserve and Treasury, a precise legal foundation, and a well-managed communication strategy. The ramifications would be seen globally, changing monetary policy and potentially hastening the transition to a financial system that is more heavily reliant on gold, with big gold-holding countries like China and Russia ready to react strategically. What short-term effects may a gold revaluation have on international financial markets? What legal and practical measures would the United States need to take to carry out such a revaluation? Please leave a comment below with your comments on Clive and Francis's gold revaluation analysis. If you find this video helpful, please give us a like and turn on notifications to stay up to date with our latest videos. I'll see you in the following video. Thank you for viewing.
I think silver is going to explode to the upside. As this chart I know you're going to show, going back 50 years in silver, there's been a 31-year formation of what we call a cup and then an 11-year handle. Now, if you remember a couple of years ago when you and I first started speaking, one of the bullish things about gold back then when it was under 2000 was it had an 11-year cup and handle formation that was ready to be taken out. And cup and handle formations 8 out of 10 times break to the upside, not to the downside. Well, silver, as you and I are literally just about to break out above the handle, which at 40 or more would clearly break out. Taking that just from the technical aspect of that, you could argue from that formation minimally, and I say this minimally, and I'm watching myself say this, Elijah, thinking I can't believe Pete Grandis is saying this, but I think silver could be triple digits. That means it's going to go to $100 or more.
Silver is currently experiencing a significant technical breakout, forming a rare and bullish cup and handle pattern that has been developing over approximately 31 years. This pattern, characterized by a rounded bottom followed by a consolidation phase, suggests a potential upward move upon breaking through the handle's resistance. Analysts are closely watching the $40 level, as surpassing this could trigger a substantial rally. Some experts like William Middlecoop and Robert Kiyosaki project that silver could reach $100 per ounce or more in the long term if this breakout materializes. Peter Grandich is a financial analyst and commentator specializing in precious metals and resource investing. He remains very bullish on both gold and silver, especially silver, which he previously considered secondary to gold. Earlier in the year, when silver dropped below $30, he shifted to a strongly bullish stance. But noticing the current situation, First Majestic Silver projects silver prices could reach $100 to $130 in the long term, citing structural supply-demand imbalances. Peter highlights that silver's long-term cup and handle pattern signals strong upside potential, while gold has broken out of a long-term inverse head and shoulders pattern around $2,075, rallying above $3,350 by August 2025. Strong monthly closes and limited retracements reflect robust buying interest and a shift in market sentiment, supported by macroeconomic factors. The gold-to-silver ratio shows gold currently leading, but Peter sees both metals poised for significant gains over the next 12 to 24 months. The excerpts from Peter's interview are now available. Please click the bell symbol to receive timely updates, and subscribe to our channel before we continue our conversation. Thank you, and have fun watching the video.
I still believe gold and silver are going higher, particularly silver, which is anybody that knows Peter Granish from just past a few months ago say, did Peter Granish just say he was bullish on silver? Because I always treated it as second class to the gold itself in terms of ownership. Not that you shouldn't own it, but, there's been people for silver for decades and, it underperformed quite a period of time. However, early in the year when it got below 30, I flipped the switch and I became as bullish, if not more bullish on silver and gold. And I'll touch on that in a moment. But the first important thing is, so earlier in the year, after owning gold for as cheap as $1,300, when it got up to its highs or within $20 of the highs, I made a decision that the major producers now could do better than the physical gold price. Plus, gold needed to go through a very long consolidated phase because of how fast it rose in the previous 12 to 18 months. So I went into the major gold producers. Then, when they did as well, and they're going to continue to do well, they're basically record amounts of free cash flow in the sense they're printing money. The bottom line then was, well, the next order of business is, you have all these folks on Wall Street telling us about AI and all these centers and all these needs. Well, they need two things. They need electrical power, which we have a huge problem. You know how I feel about the grid and the inability to deliver power. But it also is going to need a whole bunch of metals. And that's why, another metal that I like very much is copper. But there's been such a lack of worldwide exploration for these metals. The world has shrunk to where companies are willing to go because of economics and social and political causes. So I backed up the truck, so to speak, in the most riskiest of the type of stocks, what we call junior resource stocks or exploration stocks. But I want to say one thing about it. Gold and silver are just trading the best you could expect at this point in time. See, there was always an excess 20 or 30 years ago. There isn't that excess now. And the other thing is it has so much more demand and usage from an industrial usage. It's still not a monetary. I know there's a few people are trying to argue that. The central banks are not buying it in any large quantity, although out of the Middle East, we've seen a significant purchase, and that may be changing. The ratio is another reason it got way out of whack. Not that it has to be any certain ratio, but if you're going to use historically, it seemed to be favorable. And then it's just that chart. I mean, that chart, there aren't a lot of technical charts that have outstanding 8 or 9 out of 10 times it works a certain way. Cup and handles, especially the longer they are, have about an 80% correlation of that when it breaks the handle to the upside, they go up substantially. So all those things combined, and throw in the fact that the things that have been competitive against gold and silver, the stock market and crypto, they look like they're peaking. So 12 to 24 months out, they could be in a much better environment than they did previously. And I will tell you this, if we're right about the technicals, I'm not saying it's gonna, but if we're right, we're going to see momentum players show up. And when momentum players show up and the charts really take off, then all these generalists are going to get calls from their institute. How come we don't own any silver? What can we own? And you know how I know that? In the last 3 weeks, maybe the whole month of August, I heard from 10 people that I haven't heard from in 10 or 20 years. In fact, they thought I was already out of the business because I left the metals and mining business in 2013. But they saw me somewheres and all, and they're starting to go, hey, I'm starting to hear from people that know what they're talking about. What are you looking at? And I just think if we get this breakout and it's being talked even in the general financial media, the fundamentals and the supply and demand argument is so bullish. So that's why I'm so optimistic.
Peter emphasizes that gold still has significant upside potential, despite already rising substantially. Gold has entered a new bullish phase. The breakout from the long-term consolidation pattern signals strength backed by strong technical and market momentum. This suggests continued upside potential, especially if macroeconomic conditions remain favorable for precious metals. At the same time, the gold-to-silver ratio continues to show gold's dominance. The ratio remains inside a rising channel, currently holding near 90. This indicates that silver has yet to catch up, and the market continues to favor gold in uncertain times. However, the ratio's midpoint is a potential turning zone, so traders should monitor closely for any signs of silver strength. Gold remains strong with long-term bullish momentum, while silver may be approaching a turning point based on the current ratio. Investors should monitor key support and resistance levels for potential moves. Peter also advises caution with U.S. stocks, recommending a focus on international markets, particularly China, as global equities and precious metals have outperformed, and seasonal trends suggest potential weakness in the U.S. market from September into October. Let's dive into the interview.
Well, gold's moved up a lot. How much further can it go? How could it possibly go to 5 or 10,000? So when I first thought about coming in the early 1980s, when I effectively became a stockbroker in March of 1984, the Dow had gone 13 years trading between 700 and 1,000, to the point where in 1982 or 83, Business Week ran a front page story which everybody on Wall Street spoke around called Equities Are Dead. They literally, along with many others on Wall Street, viewed that just because of everything that was happening in the world and how bad things were, and Russia and the United States are going to blow each other up, Japan was going to take over the world back then, yada, 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 the Middle East. They didn't think it was possible for the Dow to go much above 1,000. And then a young man who ended up helping me a lot in my career, who no one heard of beforehand, came out of Gainesville, Georgia, named Robert Prechter Jr., with something called the Elliott wave theory, which no one was familiar with, and said, the Dow's going to 3,600. And the few people that put them on financial shows, they just put them on like you were putting on like a clown to show what an idiot this guy. How could the Dow go to 30? I remember people going, sir, how could it's never been above 1,000? And he would give the reasons and so forth. It went a lot further. It took decades, but it went a lot further than 3,600. And so I think it's a mistake to just simply say gold can't be 5 or 10,000 because it traded for so long between such and such a price. We have no idea or argument about that and so forth. Just recognize that right now, the vast majority of people, certainly in North America and particularly in the United States, don't own any. None. Not a mining stock, not physical bullion, nothing. And if that half or 1% or wherever it is, it's somewhere in that range, just switches to 2% of their portfolio, the numbers are incredible what they can get to. So that's one of the many, many reasons I think it's still important to stay very constructively bullish. And I don't believe I could start a general equity portfolio now in U.S. In fact, when I began the year, Elijah, I suggested to our clients of our planning group and anyone that wanted to listen that if you are going to own equities that are ex-U.S. equities, meaning world funds that don't hold any U.S. exposure. And in particular, a country like China that I thought would outperform the U.S. And both of those have greatly outperformed the U.S. stock market. There's a lot of excitement now, and I know I'm going on here, but because we went down sharply briefly in April and had this rally, there's a sense that this has just been a magnificent year. But right now, the U.S., despite all of this, has not been able to outperform world markets, emerging markets, China, and best of all, it's not even come close to gold and silver. Yet, if you turn on a financial network, that's all they talk about is the U.S. market. So all of that led to this belief, but because the last 2 weeks in August tend to be extremely seasonally bullish, because people are taking their last of their vacations and all, I said not to worry about a defensive position until after Labor Day, which ironically, we begin one of the more seasonally weak periods for the stock market, September into October. So all in all, I think it's the greatest minimum now. You need to be much more concerned about the U.S. stock market now than you might have been a few weeks ago.
Peter Grandich underscores a bullish outlook for both gold and silver, with silver showing a rare long-term cup and handle breakout, and gold maintaining strong momentum after a major inverse head and shoulders breakout. While gold currently leads, silver's technical setup and potential inflection in the gold-to-silver ratio suggest significant upside over the next 12 to 24 months. Investors should also monitor key resistance and support levels while exercising caution in U.S. equities and considering opportunities in international markets. How might the potential $40 breakout in silver impact investor sentiment and market participation? What key levels should traders watch in gold and silver to confirm continued bullish momentum? Share your thoughts in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.